Hey, Raiden, you want to hear a dirty word?
Well, what's the word?
Annuities. We day in and day out will have conversations with people that have read about or heard about or been talked to about an annuity. And it just can be confusing for them at times. It can be overwhelming. And so that's what we're talking about today.
Well, I'm excited to talk about that dirty word there, Merce. We are going to introduce that in this show, and then we're going to have future episodes that we go into more detail. But in this show, we are going to introduce why somebody would ever look at an annuity and what are the different types of annuities. And then we'll go into much more detail in the future episodes. But we've been introducing you to the idea that we want to hear from you. So if you have any questions that you ever want us to consider in future episodes or anything you'd like to mention to us, we have set up a way for you to send us a direct text. The text number is 984 207 1753. Again, that's 984 207 1753. Please send us a text. We'll make sure, if at all possible, that we try to answer all of your questions in future episodes. But for today, we hope you enjoy the show and hear our understanding and understand yourself, rather, annuities. It's nice to have you with us on our podcast. Today, we are going to talk about something that can be complicated, can be misunderstood, can be talked about in a very negative way. What are we talking about? Well, we're going to talk about annuities and how they get used and why we would ever talk about them, how we would use them. And I will tell you that this is a huge topic. And today, our goal on this particular episode is to basically introduce the idea of why annuities would ever be used. We'll talk a little bit about the pros and cons, but I'm just going to set it up right now. We're not going to be able to go into all the details today, but we will have future episodes that we come back and we start hitting on some of these topics as we delve into them deeper. So I'm going to ask Merce, because Merce builds all of our retirement plans when it comes to the, using the software and doing all that. So Merce, as you're building a retirement plan, what is the number one thing that we have to consider, that a client has to consider when they're looking at their retirement plan?
Yeah, the main focus of the retirement income plan is basically income. Where's the money going to come from? And so we have a whole conversation when we're building these out to get a good understanding of fixed income sources, understanding the assets and how those can possibly generate income. But really what it comes down to is, how are we going to keep the bills being paid? And so we basically break things down very simply when we're building these is, you've got a couple different types of expenses. You've got your essential needs, which is in all essence, everything that you need to stay relatively happy is how I say it. So in order to pay the bills, pay the mortgage, keep yourself fed, keep yourself clothed, and just the little things here and there. And then you've got your wants. And your wants are things that, you can technically live without. I say technically because, well, you get to the point where you're in retirement or close to retirement, you work so hard. And if I was to tell you, well, you have to give up all your wants, you would say, well, why have I worked so hard? I want to be able to enjoy my retirement. And I want to have those wants, whether it's, traveling or spending on a grandchild or having a membership to a golf club or whatever it is, keep maintaining your hobbies. Wants are typically included in the retirement income plan just because, you want them and you've worked hard for them. So what we really like to see when we're building these out is at the very least, the essential income needs are covered from fixed income sources. So when I say fixed income sources, typically what we're talking about there is Social Security. You can start it as early as 62. It maxes out at age 70, and you can take it anywhere in between then. So that in itself is a whole conversation of when do we turn on Social Security. As you wait, the dollar amount that you get goes up, and that's a fixed number that's guaranteed by the government. And we can have a whole nother conversation around that as well. Another fixed income source could be a pension. 10, 15, 20 years ago, I could say that's a very common fixed income source. Not so much anymore, but we still have clients that get pensions and they bring in tremendous value to the income plan. Quite honestly, we have some clients that between Social Security and their pensions, that's all they need. And everything else is really just there for emergencies or for inheritance. So that's a great situation to be in. So when we're structuring an income plan, we want to try to get the essential income needs covered, and then let the assets take care of the wants. So, when we talk about places outside of Social Security and we outside of a pension, if there is one, well, where else do you get it? And where else can it be guaranteed? And when we talk about that, that list becomes very, very narrow when we're talking about guarantees. We can't guarantee it in the stock market. Everyone knows that. Stock market goes up and down. 2020, case in point, it's been all over the place. So when we're talking about guarantees, you're really limited to, in our opinion, four different things. You've got CDs, certificates of deposits. Basically, what that is you're kind of saying, well, I'll give the bank some money and they're going to guarantee me a rate of return. Go back 20 years, that rate of return was pretty great, anywhere from 5 to 10%. And that could be good enough to structure fixed income. Not so much anymore. If you're looking at a 1, 2, 3 year CD, you're barely getting above 1%. Another place that used to be really good is money markets. Money markets used to pay a very high interest rate and something that you could count on. And so you can know that if I put in $100,000, I know what the interest is going to be, and that could be my fixed income source. Well, once again, not the case anymore. Interest rates are very low. Treasury bonds backed by the government. You can count on them not going down to a degree, but once again, the interest rate there is very low. So at the end of the day, the fixed income sources that were relied upon 20, 25 years ago are not as attractive anymore. So in comes the annuity world. And so Radon, can you take us through, what we think through in the annuity world, why it could be considered as a fixed income source and some of the ins and outs there?
Yeah. So basically, what I try to help people to appreciate is that if you are ever talking to anyone about an annuity, you need to understand the why more than the how, because annuities are complicated. There are a lot of different annuities out there, but if you understand the why you would ever do an annuity and you get that so clear in your head, then it always helps you to be able to identify the answer to the question as to why did you do this? Why was it you looked at an annuity? So I think when we consider annuities, we believe that there's really three reasons to look at an annuity. Number one is income. It can provide an income, and that might be the thing we need. The second one is safe growth, meaning I can use an annuity for a safe money alternative, meaning I can use it as an alternative rather for a bond or a CD. And the third one is death benefit. And sometimes people go, I just want to make sure I got a death benefit for somebody. Now, I will tell you the death benefit is the least reason for most people. Number one is income, and number two is a safe money alternative. And so we're going to talk about the annuities from that perspective as to those two things. Now, when we look at annuities, if we're going to let those be our guidelines, now it narrows it way down. We can get down we can take what are many, many, many different options and we can narrow it down to something simple. So as we start thinking about income and a safe money alternative, well, now let's just say, well, where do we go? Okay, so let's just break annuities down into two major categories. There are what are called immediate annuities, and then there's what's called deferred annuities. An immediate annuity is when you take a lump sum of money, you give it to the insurance company, and then they convert that lump sum of money into an income stream that you cannot outlive, a lifetime income. So the positive is you're going to get an income stream for the rest of your life, no matter how long you live. The negative is that, and what a lot of people don't like, is that you've now converted a lump sum of money into an income stream. So it's fixed. You no longer have the lump sum of money. So if you gave the insurance company $100,000 and they said for that $100,000, we'll give you $500 a month, you cannot go back and say to the insurance company, I need a little bit more money. And so where's my account? There is no account. You've converted the $100,000 into a $500 lifetime income. And I'm using that as just a hypothetical. So because there's a lot of rigid parts of an immediate annuity, it's a irrevocable transaction. Sometimes people say, I want more flexibility, and that moves us over into the other world called deferred. Now, there's really two types of deferred. So one is called a variable, and the other is called fixed. A variable annuity still has the risk of the market, meaning I'm investing in a variable annuity, I'm investing in mutual funds. Now, there are riders that I can add to that variable annuity to give me guaranteed income, but it's expensive. Yet when you add on those fees over in the variable annuity world, you can see your fees get as high as 3 to 5% a year just to carry those guarantees. And that makes it, to us, not a place to put money if I'm looking for those two key things. Remember what those are: income, safe money alternative. So that really puts us over into the deferred world. And in the deferred world the deferred world of fixed, within that world of deferred, that's where we want to be, fixed. Fixed means I cannot lose my principal due to a negative interest rate environment. I can only have my principal go down if I pull money out of the annuity. So there's really two types of fixed annuities. One is called a declared rate. That looks a lot like a CD. So I'm going to make 2% for 5 years, 3% for 5, whatever the rates are currently. And at the end of that 5-year period, or whatever period it is that I signed up for, I can now walk away from the annuity, or I can turn on income if I want to. There's another one called a fixed annuity still, but it is indexed to some type of an index, meaning it's linked to an index, and then that determines my interest rate. Now, in that index world, I can have years or a year where I made zero, but I just cannot lose, even if the index is negative. So I could make a zero, but I could have years where I make a lot more than what I could have made in the declared rate. So I have some interest rate risk, but I have no downside risk within that fixed deferred annuity that's linked to an index. So that's really the world of annuities. Now, if Merce and I were going to sit here and take you through all the details of that, it would take us a very, very long time to do that. So what we're going to do is we're going to have future episodes that take us through details of how these work. I will tell you that for Merce and I, in our practice, we only stay in that fixed arena. So either fixed declared rate or fixed index rate. Now, the fixed declared, pretty simple. Whatever the rates are, the rates are. Our complications occur, meaning when I say complications, there's a lot of details to know, is over in the fixed index world. And so our goal as we go forward is, how do we take a fixed index annuity, understand it, number one, and then how does it provide us lifetime income? How does it give us a safe money alternative to, again, compare them to CDs and compare them to bonds? By the way, I will tell you one negative that I'll handle right now before we go, is you might hear somebody say, wait a minute, why would you ever do a fixed annuity if you could just do a diversified portfolio in the market? You could outperform it. Do not allow anyone, in my opinion, and I think that we're very strict about this, you do not compare a fixed index annuity to the stock market. That is a very wrong comparison. The comparison should be to a CD or a bond. So you say, well, okay, well, now I understand. I'm this a part of the plan. It's not the plan. We're not trying to say it's going to outperform the stock market. What we're saying is we can actually have an annuity that takes away the risk of the stock market, but the return is going to be something that's trying to compete with something like a CD or a bond. And we'll go into all those details, but we wanted to at least open up the conversation. before we start delving into all these things. And in future episodes, we'll start to go through all of these different topics. So we appreciate you listening. We know we just opened up the conversation. We hope that we can give you a lot more details going forward. But as always, we ask, if you've not already, please subscribe to the show. Please give us a 5-star rating and a review. And we would love to hear from you. So please reach out to us with any questions you'd like for us to consider going forward. Thank you very much. We hope you have a great day.